studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Meals and entertainment expenses are one of the most common adjustments you'll encounter on Schedule 1. And they're also one of the easiest to understand once you know the basic rule. When a business incurs a legitimate meal or entertainment expense for business purposes, the entire amount is normally recorded as an expense in the accounting records. From an accounting perspective, if the company spends $200 on a business lunch, the full $200 reduces the accounting profit. However, the tax treatment is different. Under the Income Tax Act, only 50% of most eligible meals and entertainment expenses are deductible for income tax purposes. This means that while the accounting records recognize the full expense, the CRA allows only half of that amount to reduce taxable income. Let's look at a simple example. Suppose the corporation pays $200 for a business lunch with a client. The accounting records will show a meals and entertainment expense of $200. For tax purposes, only $100 is deductible. The remaining $100 is considered non-deductible and must be added back on Schedule 1. A simple way to remember this is to imagine every eligible business meal being divided into two equal halves. One half is allowed as a tax deduction, while the other half is added back when calculating taxable income. This adjustment does not mean the expense wasn't legitimate. It simply reflects a difference between accounting rules and tax legislation. So the process is straightforward. Record 100% of the expense in the accounting records. Claim only 50% as a tax deduction, and add back the remaining 50% on Schedule 1. As we'll see in the next sections, there are some important exceptions to this general rule. But for most business meals and entertainment expenses, remembering the 50% rule will help you correctly prepare one of the most common Schedule 1 adjustments. When preparing a corporate tax return, it's important to understand not only the 50% rule, but also exactly how that adjustment flows through Schedule 1. Let's walk through a simple example. Suppose the corporation has recorded $2,000 of meals and entertainment expenses in its general ledger. Since accounting standards recognize the full amount as a business expense, the entire $2,000 appears on the income statement and reduces the corporation's accounting net income. However, tax rules allow only 50% of that expense as a deduction. This means that only $1,000 is deductible for income tax purposes. The remaining $1,000 is considered non-deductible and must be added back on Schedule 1. Notice what happens to taxable income. Because we're adding back the non-deductible portion, the corporation's taxable income increases by $1,000. For example, if the accounting income before the adjustment is $80,000, adding back $1,000 results in taxable income of $81,000. In most professional tax software, this adjustment is often calculated automatically once the meals and entertainment expense has been identified correctly. The software can transfer the information, perform the calculation, and update the taxable income. However, it's still the tax preparer's responsibility to review the expense account and confirm that the amount recorded actually represents meals and entertainment expenses that are subject to the 50% rule. One of the most common mistakes beginners make is adding back the entire meals expense instead of only the non-deductible 50%. Remember, if the business recorded $2,000 of eligible meals and entertainment expenses, you do not add back the full $2,000. You add back only $1,000 because the other $1,000 remains deductible. A simple way to remember the process is this. Record 100% of the expense in the accounting records. Allow 50% as a tax deduction. and add back the remaining 50% on Schedule 1. Following this workflow will ensure that the corporation's taxable income is calculated correctly. Before we move on to the exceptions and detailed CRA guidance, let's summarize the key points every tax preparer should remember about meals and entertainment expenses. In most situations, legitimate business meals and entertainment expenses are only 50% deductible for income tax purposes. This includes common expenses such as client lunches, business meetings over coffee, meals during business discussions, and many other ordinary business-related meal expenses. Although these expenses are fully recorded in the accounting records, only half of the amount is allowed as a tax deduction. The remaining 50% must be added back on Schedule 1, which increases the corporation's taxable income. Accurate documentation is just as important as the calculation itself. Whenever a meals and entertainment expense is claimed, the corporation should keep the receipt, record the date of the expense, identify who attended the meeting, document the business purpose, and note where the meeting took place. Good documentation helps support the deduction if the CRA ever reviews the return. Before filing the corporate tax return, it's good practice to review the meals and entertainment expense account. Remove any personal or non-business meals. Confirm that each expense has a valid business purpose. Verify that the 50% adjustment has been made correctly on Schedule 1, and ensure that the tax software has calculated the adjustment properly. The rule itself is easy to remember. Record 100% of the eligible business meal in the accounting records. Claim only 50% as a tax deduction. Then add back the remaining 50% on Schedule 1. If you remember these 3 simple steps, you'll be able to correctly handle one of the most common adjustments you'll encounter in Canadian corporate tax. In the next section, we'll build on this foundation by exploring the CRA's detailed guidance, special situations, and important exceptions to the 50% rule.